Monthly dividends, 98.5% occupancy, over $80 billion in real estate. Realty Income is one of the most popular REITs out there, but is it still a smart investment in 2025? Let's break down what they do, their financials, and the latest Q1 report. Realty Income got its start in 1969 with a single investment in a Taco Bell. Today, the retail REIT owns thousands of properties across America, leased to hundreds of tenants operating in dozens of industries. Retail properties account for most of the firm's rental revenue, with industrial warehouses and gaming venues generating almost all of the remainder. All properties are under long-term, triple-net lease agreements, which shift property operating expenses to tenants and generate predictable cash flow to fund monthly dividend payments. Realty Income currently pays an annual dividend of $3.23, distributed monthly. The next dividend payment will be on July 15th, and anyone who owned the stock by July 1 is eligible to receive it. The starting dividend yield at the current price is 5.6%, compared to the 5-year average of just 4.81%. The price to AFFO ratio is currently 13.5, while the 5-year average is 16, and the sector average is 14.9. The expected price range is somewhere between $60 and $74, while the current share price is around $57. Based on this, the company may be slightly undervalued. Over the past 12 months, the dividend was increased by 3.2%. The 5-year average dividend growth rate is 2.9%, while the 10-year average is 3.6%. The dividend has not been cut in 56 years, and it has been increased every single year for the past 30 years. The FFO payout ratio has consistently remained below the expected 90% threshold in recent years, and in fact, there's been a noticeable downward trend. FFO per share has been growing steadily year over year, a crucial factor for future dividend increases. Over the past 5 years, it has grown by an average of 5.2%, which is well above the dividend growth rate. This has given the company some breathing room to acquire or renovate more properties, or even to raise dividends more aggressively in the future. Like most REITs, Realty Income continuously issues new shares to help accelerate portfolio growth. What's reassuring is that the total sales chart also reflects this growth trend. As a REIT, the company is required to pay out a large portion of its income as dividends in exchange for favorable tax treatment. That's why the number of outstanding shares increases year after year. The capital raised from new shares, along with debt, is used to expand the portfolio. This means more shareholders to pay dividends to. But as long as revenue grows at the same pace or faster, there's no reason for concern. In the past, the company's debt levels were slightly above what's considered healthy, but that seems to have been addressed and hopefully will remain under control long term. The interest coverage ratio has also consistently remained above the expected level for the past 10 years. Realty Income is currently available with a starting dividend yield of 5.6%, and the dividend has increased by 3.2% over the past 12 months. With a credit rating of A-, the dividend appears to be safe, and further dividend increases are expected going forward, just as they have been in the past. Disclaimer: this video is for informational and educational purposes only. It does not constitute financial advice. Always do your own research before making any investment decisions, and never base a financial decision solely on the content of this video. Now, let's dive into Realty Income's latest quarterly results, Q1 2025. The numbers show strength, consistency, and resilience, exactly what you'd expect from a dividend aristocrat. In the first quarter, Realty Income invested $1.4 billion in properties. $893 million was deployed in Europe with a 7% cash yield and $479 million in the US at 8.3%. This results in a strong weighted average cash yield of 7.5%. Adjusted funds from operations per share came in at $1.66, up 2.9% year over year. Occupancy remained exceptional at 98.5%, reflecting the quality of their real estate portfolio. They executed 194 lease renewals at a rent recapture rate of 103.9%, meaning they were able to re-lease space at even higher rents. On the disposition side, 55 properties were sold for net proceeds of $93 million, showing good capital recycling. For the full year 2025, Realty Income reaffirmed their AFFO per share guidance of $4.22 to $4.28. This consistent outlook demonstrates confidence despite macro uncertainty. Liquidity stood at $3.1 billion and their balance sheet remains solid. Realty Income holds an A3/A- credit rating with a net debt to EBITDA ratio of 5.4x, and 94% of debt is fixed rate, reducing interest rate exposure. Overall, Realty Income continues to perform like a textbook example of a reliable REIT: steady dividends, conservative balance sheet, and consistent operational execution. Let me know in the comments, do you hold Realty Income in your portfolio, or are you waiting for a better entry point? Thanks for watching, and if you found value in today's video, give it a thumbs up and consider subscribing for more smart, long-term investing ideas. Stay patient, stay consistent, and keep building your path to financial freedom. Until next time, take care and happy investing.